So this is a presentation. It's an adaptation from a seminar I went to presented by Ed Slott, well-renowned presenter and practitioner, CPA, all things taxes. So condense it into, I think, a very good presentation. I hope you enjoy it. I really liked one of the things that he said when we were there. He said, how to keep your IRA from becoming an IOU to the IRS. And I think I can remember that. And that definitely draws some strong emotions as well. We certainly don't want to write checks to the IRS any more than we have to. So how a tax-free Roth IRA can benefit you and fit into your retirement plan. So just a little bit of information about me. If I haven't met you, name, address, email, website, phone, etc., and disclosure information. Okay, so 3 parts. One is how a tax-free, a Roth IRA planning after the Tax Act. Then 3 questions to ask in every Roth conversion evaluation, and who should and who should not convert. So those are the 3 things we're going to go into this evening. First off, what are the benefits of a Roth IRA? Well, tremendous amount of benefits. Tax-free income in retirement, huge. You know, my saying is pay the taxes when you have an income, so you don't have to pay the taxes when you don't have an income. I know that's kind of a simple way to convey that message, but basically, if you can, let's pay the taxes now, so you don't have to pay the taxes when in the future when you're retired, you don't have an income. There's also no required minimum distributions for Roth IRA owners. There are for the beneficiaries, but not for the owners. Remove the uncertainty of what future tax rates might be. So every administration changes the tax code practically, not everyone, but almost everyone. So if you want to eliminate that from your plans, a good way to do that is to convert as much of your IRAs as possible to Roth IRAs or start IRAs. So this is the first way to incorporate Roth IRAs into the planning. Just start a Roth IRA. So if you're participating in a workplace plan and you are married, then you can contribute and your gross income is under $204,000. You can both max out your contributions to Roth IRAs. So if you're under 50, that would be, 49 or younger, that'd be $6,000 per person if you're married. And then if you're at 50 or over, it's $7,000 per person, again, if you're married. So a single person would have to have a modified adjusted gross income under $129,000. So modified adjusted gross income for all practical purposes is your adjusted gross income with a few add backs. But for the most part, if you look at your adjusted gross income that you have, that's usually on the first page of your 1040 form for your taxes, that's the number we're looking at. So you're allowed to take out charitable contributions, deduction for dependents, mortgage interest deductions, and that type of thing. It usually gives you your. So that's one way. You just simply start a Roth IRA. And we encourage folks, we talk about that all the time with our clients. So if you're out of that income range and that's not a possibility for you, you can certainly contribute to the Roth side of your 401k. It could be TSP, 403b, et cetera, as well. We're going to just use 401k generically at work. There's no income limits there. There's a contribution limit. So in the first idea, we had an income limit and a contribution limit. Here we just have a contribution limit. So it's $20,500 for folks 49 and younger, and if you're over 50, you can put in another $6,500. Now, I run into some confusion recently that this kind of bypassed me before. A lot of folks thought that if I don't put in pre-tax amount, I won't get a match. Not the case. Your contribution is what counts for the match. So if you put in $20,500 and you get, say, a 5% match on your salary, you'll still get that whether you put it into the Roth side or the traditional side. So second way is to contribute to your 401k at work. And then the third way is to contribute or do a conversion. So, if you're a client of mine, you will know that we'll talk about this. We'll talk about converting your Roth IRA or your IRA to a Roth IRA. There's no income limits. There's no conversion limits. There's just a tax limit, taxes payable. You just need to be able to pay your taxes from other accounts. You don't want to take them from this, from the converted money. You want to take them from other accounts. That's the third way. Then the fourth way, and we kind of talked about this already, is just start a spousal IRA, Roth IRA, excuse me. The contribution limits are the same, 6,000 if you're 49 and under, 7 if you're 50 or older per person. An individual can make Roth contributions up for a non-working spouse. So if the income allows and you have the extra funds, don't have to be working. You just have to be able to file a joint return and make at least the amount you're contributing. So if you're contributing 7,000, you need, per person, you need to be able to make 14,000. If you're contributing 12,000, 6 per person, you need to be able to show a tax return of at least 12,000. So that's the fourth way to start a Roth IRA. So one of the other reasons Roth IRAs are beneficial is they pass tax-free to beneficiaries. So this is huge, if you're interested in sparing your beneficiaries from that tax burden. Let's just say, in contrast, you have $1 million Roth IRA, and that passes to children. Let's just say you have $1 million left over. That passes to children. They're going to be paying taxes on those withdrawals. And if you look at the letter A, they have to take those withdrawals out within 10 years. So it's a huge tax hit. I mean, potentially sending beneficiaries up a couple different tax brackets in their income. And again, it has to be all pulled out in 10 years. That's a recent change. But with Roth IRAs, we're saved from all that. We still have to pull the amounts out within 10 years, but it's tax-free. Okay, it's tax-free. Very, very big plus for a Roth IRA. The only person that's excluded from the 10-year rule is the spouse. So if a spouse is named as the beneficiary and all the funds go to him or her, then they can stretch it out over their lifetime. But anyone else, son, daughter, aunt, uncle, etc., they all have to pull out all the funds in the 10 years. That's new rule. But again, tax-free. So what's considered a qualified Roth distribution? I'm asked this quite frequently. Basically, it's a distribution that's not subject to taxes or penalties. So what does it take to have a tax-free? Well, the distribution has to be made 5 years after the Roth was established, and the taxpayer is 59 and a half. So my answer is 5 years and 59 and a half. So we'll talk about the reason to start a Roth IRA sooner, as soon as possible, here in a minute. The distribution you can also take a distribution based on death, disability, or first-time home purchase. I was just asked about the first-time home purchase the other day, and yes, you can do that, but I really recommend you don't. Because think about it, the money you put in a Roth IRA is after-tax money. So, for example, if you can put in, you're over 50, you can put in $7,000 into a Roth IRA. You had to earn, $10, $11, $12,000 to net $7,000 to put it into the Roth IRA. So you really have to earn, if you take those funds out, you have to earn, again, quite a bit of money to replace it. And you can only still max out $7,000 a year into a Roth IRA or whatever the limits inside your plan, your workplace plan. Roth distributions. Taxpayer is not able to take a qualified distribution, but still be able to take distributions from their basis. So your basis here is the amount you contributed or converted. So if, for example, over my lifetime, I put $100,000 into a Roth IRA and it grows to $150,000, then that $100,000 contribution, my basis, I can take out any time. I don't have to wait for the 59 and 5 years and a half. Okay. If you do a distribution from a conversion, so remember, conversion is we have an IRA, we transfer the IRA to the Roth IRA, and that conversion, the amount that you convert is penalized if you're not 59 and a half, or this is an or situation now, or 5 years in the plan. Okay, so the distribution or a distribution from conversions have a little bit different rule. You have to be 59 and a half or had the account open for 5 years. A non-qualified distribution of earnings would be subject to income tax. So And that's just a 10% penalty on the earnings. Very, very clear. That's why I want to underline. It's just the earnings. Let me show it to you in a graph, and maybe that'll, resonate with even more folks. So contributions. Okay, so you start a Roth IRA, you contribute to the Roth IRA. All the money you put in, you can pull out anytime, tax-free, penalty-free. Now, we don't ever plan to do that, but you can. Any money that's as a result of conversion, so you have an IRA, let's just say you convert 100,000 of an IRA to a Roth IRA, you just have to wait 5 years or be 59 and a half for that converted amount to be not taxable. Okay, I'm sorry, not penalized. Excuse me, not penalized. It's never taxable. It's only penalized if you take it out within 5 years or 59 and a half. In the case of earnings, though, they have to be, it's an and situation, they have to be in the account 5 years and 59 and a half. So you put in 100,000, it grows to 125,000. Those earnings have to have a 5 year and 59 and a half have met that requirement. Okay, this is my favorite slide. When is the best time to convert? When the market's down. This is one of the reasons I wanted to do this presentation right now. A lot of folks say, oh, the market's down. And yes, it is down. I don't like it. We can chat about some different things we can do with your account and different strategies we can use to help you. Some is changing, maybe changing management solutions strategies, maybe introducing some other products into it, etc. But one of the great things about the market down is it's super time to convert, right? So let's just say you have a $1 million IRA and now it's worth 800,000. So if you convert 100,000 of that IRA on a percentage basis, you've converted more than you would if it was $1 million. So great time to think about that. And we would never suggest you convert a large IRA all at once. We would suggest you do it in smaller increments over time, something that you can manage on a tax basis. The other real important point is tax rate sunset right now in the current law 2025. And a lot of people are forgetting that. I seriously doubt that they will remain as low as they are now. Remember, the brackets widen, the rates are lower. I mean, we're really living in a for tax purposes, a good season. So if you're thinking about making conversions now, we're talking about doing as many as you can before 2025. Makes a lot of sense. Now, maybe we get in a more conservative administration. Maybe we get in someone who wants to, administration that wants to maintain the existing tax rates. That would be great, but I don't see that as part of the plan. Hold on one moment. Looks like we got a question. See if we can answer. Sunset. Okay. So sunset, all that means is that's when the current law expires. Okay. So remember during the Trump administration, they had the new tax laws that came into place, and they had a 10-year window on that. That's going to expire in 2025. So in 2026, it'll revert back to the old rates. That is previous to the current rates, unless something's done. Okay, so the market's down. So hopefully I know you certainly feel that, but maybe you see that as a reason to convert some of your funds. I just explained to you that the current rates are going to go up potentially in 2026. So that might be another reason that you think about converting some of your Roth IRA or IRAs. But the other scenarios, so I have best, better, and good. So your Medicare rates are based on your income. When you make a conversion from an IRA to Roth IRA, that adds to your income. Your Medicare rates are based on your 2-year previous tax return. So if you are taking Medicare at 65, so you're retired, you take Medicare at 65, that's what most folks do. That's when you have to sign up, or you have to have someone's going to deferment if you're still working beyond that. But let's assume you take Medicare at 65, Medicare Part B we're talking about. If you can convert as much as you can before age 62, then that means you won't be included in that Medicare look back for the rates. So Medicare is going to look at your age 63 tax returns, and that's going to be your rate for Medicare premiums that year. If you're able to convert, before age 62, and I know that's a big ask because your income's peaking, you're like, what? You want me to, convert my income's up? Yes, I do, because I'd rather you pay taxes when you have an income as opposed when you don't. So that'd be the best scenario, but that's not always workable. So the other part would be, let's convert before we start Social Security. So if you're able, we'll talk about in many scenarios waiting to take Social Security till age 70, because that's when you get the biggest benefit, especially for the highest income earner in the family. We really encourage them to wait till age 70 because that becomes a survivorship benefit to the other spouse. So if we can wait till 69, if we can convert as much as possible before 69 and Social Security starts, which then raises our income, that will hopefully keep us in a lower tax bracket. So the other scenario would be a good scenario. That's what I call it. So required minimum distribution for your IRA start at 72 now. There's some legislation going through that might up that to 75, which would be super, I think. But for right now, it's 72. So a good scenario would be to convert before age 71 as much as you can into from IRAs to Roth IRAs. Typically, we have this discussion with clients between age 65 and 70. And basically, we're talking about between the age of retirement, around 65, and before we start Social Security, which again, if we can wait, would be age 70. So that's typically when we see it done, but there are some best, better, and good scenarios that I've laid out there that certainly would be times to consider converting as well. Okay. Oh, well, let me just make sure I didn't miss anything. Okay. Who can do a Roth IRA conversion? The answer is anyone. All right. Anyone with a pre-tax IRA. So traditional IRA owners can do Roth conversion. This group includes individuals with SEP IRAs. So that would be folks that have some self-employment income. Simple IRAs, those usually are for small employers. And then folks that are in 401ks, 403bs, TSPs, et cetera, can also make conversions, but they first have to transfer those funds to an IRA. Now, that only works if you're 59 and a half. Okay, so don't get too excited about that if you're not 59 and a half. So many plans, TSP, a lot of 401ks will allow you to do an in-service distribution or transfer your funds. They allow that once to an IRA. So if you're able to do, if you're still working, and in one of those plans, you're 59 and a half, you could transfer your funds into an IRA, which would then allow you to convert them. The three questions you should ask for every Roth conversion. The first is, are you sure? And then you want to ask when, what, and where. So when will the money be needed? Okay, the correct answer is 10 to 15 years or beyond, right? To really take advantage of a Roth conversion, again, that's what we're talking about here, Roth conversion, you want to think of a long period of time. Something's going to give you many years of compounded tax-free growth. What will my future income tax rate be compared to current taxes? Well, I just told you that the tax rates are going to sunset in 2026, 2025. And then the new rates will be, or the old rates potentially 2026. So we hypothetically, it looks like the rates are going to go up. Now, administration could get in and make the other ones permanent, but we just spent a lot of money with stimulus. That's not likely to be the scenario. What will your current tax rate be? Will you be in a higher bracket or lower bracket? Conventional wisdom used to be you'd be in a lower bracket, but I wouldn't necessarily count on that. That might not be your case. Where will the money to pay taxes come from? So this is important. So again, we're talking about conversions. Do you have funds available to pay the conversion from other accounts, like savings accounts, checking accounts, CDs? Basically, we're looking for cash. You have cash other places. Another idea would be a brokerage account. I'll take the money from a brokerage account. but you don't want to take it from an IRA. That is, you don't want to think of, okay, let me of this $1 million IRA, I want to convert 100,000, but I'm going to have to pay like 20% in taxes. So of that $100,000 conversion, I'm only going to put 80 into a Roth. That's a real problem, right? Because when you do that, when you take the money out of the converted monies, then, and you're under 59 and a half, now you have a tax situation and a penalty. Okay, so that's the bullet number B. Pay the conversion tax from non-IRA funds. Any funds that aren't converted, withdrawn will be taxed and penalized. Penalized if you're under 59 and a half, but also taxed. So it's important to know too, the converted amounts are added to your ordinary income. So if you're in a situation like I just described earlier, where you are taking Medicare Part B, paying Part B or Part D premiums, that's going to be included in that income calculation. You know, if you're a situation where there was a phase out or a financial aid, or you know, maybe you had children late in life and you still have kids in college and you're filling out the FAFSA form, you know, you just want to be careful about that you're converting to save money in retirement doesn't also put you out of maybe a different credit or program that you were included in. So just an important note. Who else should convert? Anyone who wants to take advantage of a down market. Let's see if I got a chat here. Hold on. Okay. How would you know how much taxes you would have to pay if you convert from an IRA to a Roth IRA? Should I wait till 59 and a half to convert? Or age 50 would be nice. Okay. So the taxes that you pay on the conversion, we'll go with a couple exercises, Terrence, and I think will help with that. But basically, the amount you convert is income for which you had no taxes withheld. So let's just say you make 100,000, you convert 50,000. Now your income for that year is 150,000. Okay. So you didn't have any taxes withheld on that 50,000. So you need to be able to write the check for those additional taxes from other money, savings, checking, et cetera, that you have. Okay. Waiting till 59 and a half doesn't really matter on a conversion. You know, it does if you want to be able to take the funds out, but you know, I would suggest that would be a good goal. I'm a big fan of converting right now. One of the reasons, again, two of the reasons I want to do this presentation at this time, this season in our market cycle, is that the market's down. So again, we're converting more on a percentage basis, and also the tax rates are set to, right now programmed to sunset 2025. But if you want to go deeper on that, just let me know. I'll be glad to chat more offline. Okay. So anyone can take advantage, anyone wants to take advantage of a down market. Certainly that's the situation now. Might go down a little bit more, hope not, but you know, there's always that possibility. Those expect their future tax rates to be higher, especially those who are worried about future tax rates increases, how they might impact them. Yeah, I mean, look at all the stimulus we just, distributed during COVID. I seriously doubt, and all the spending, say, on Ukraine and other things that are going on, I don't expect our tax rates to go down. So I would, if I was to make a prediction, I would say they're going to stay the same or go up. And here's the big one: those who want to minimize their taxes in retirement. So when can you afford the taxes the least? When you're retired, right? If all you have is IRA money, okay, again, I just use $1 million because that's just a round number. You know, if all you have is $1 million in IRA money, you're going to net, $650,000, $700,000 by the time you withdraw it all because of state and federal taxes. Maybe not state taxes if you live in a tax-free state, but certainly federal taxes. In contrast, if that $1 million is in a Roth IRA, you pull it out when you want, however much you want, tax-free. You don't have the income, and in retirement, by definition, we don't have the income to make up for additional taxes. So, huge fan. The other thing it does is it gives you choices. So even if you're not able to convert, all your retirement accounts to a Roth IRA, let's just say hypothetically, you got 500 in an IRA, 500 in a Roth IRA, 500 in a brokerage account, all taxed differently, all have different pros and cons. Now you can navigate future tax situations by just drawing from different accounts. For example, if we're in a low tax season, then maybe the IRA you want to pull from more. If we're in a high tax season administration, then maybe you want to pull more from the Roth IRA or the brokerage account. So the Roth, having a well-funded Roth IRA gives you advantages. Okay, who else you convert? Those who don't need the money sooner at all, especially those who plan to pass these funds on the beneficiaries. This is really awesome. If you've been fortunate enough to, you've worked hard, you've saved, and you have, a well-funded retirement, and you get to do everything you want to do, and you're able to leave, funds to beneficiaries. Boy, in a Roth IRA is just such a great way to do that, because even though they have to spend those monies down in 10 years, like I said in a previous slide, they don't have to pay any taxes on them. So it's a really great plan for changing the legacy of your family. So you also eliminate the tax bill for those beneficiaries. Now, if your plan is to leave some money to a charity, then leave those funds in an IRA, because anytime you have a charity as a beneficiary, it goes tax-free. So that would be my only, sub point there. Individuals who don't need the money probably should convert. They're doing it for their children, grandchildren, or beneficiaries. Those who've had certain tax characteristics, so they can convert at a lower rate or convert at a lower cost. So when's your low rate? So I suggested, before 662 or before, if you can. I suggested also before age 70 and 72. But in general, our tax rate is going to drop the year after we retire. So if we retire in the middle of a year, yes, our tax rate is going to drop because we're in a lower income bracket probably, but certainly the next year. So that's a good time to start thinking about it. The first full year after you retire is to look hard at doing some conversions, because you'll be in a lower tax rate by definition, retired. You'll be in a lower tax bracket. I think most people, that'll be their case. You can have higher deductions, tax credits, other benefits that can be used to offset Roth conversion. So one of my big ideas, and I just had a client do this, I was super excited. He has a pretty good giving goal, and he has a large IRA, Roth IRAs. So what I suggested to him, and he ended up doing this, I said, let's convert $100,000 of your IRA, and in return, contribute a bunch of those, a big amount to a donor advised fund, which basically negates the bulk of those taxes. So that's my big idea. If you're charitably inclined, and you have a pretty big goal for giving to charity already, do the conversion, which is an income tax event for you, but then negate those taxes by donating, a bunch of money to a donor advised fund. So we want to go too deep in a donor advised fund, but a donor advised fund let you contribute funds, but distribute them in the future. So that's why you can over contribute to them again if you have the ability to do that. Who else should convert? Those who have money in non-IRA funds can pay the tax bill. Again, you need to be able to pay the taxes, but don't use converted money to pay the tax bill. Those will generally not pay. It'll be worse for those under 59.5 because you get a 10% penalty. And then finally, young people. So I'll see some young folks that either they didn't know about it or didn't have it as an option, and all they have is an IRA. They're in the low tax bracket. It's a small 401k. I'll just say, hey, let's convert it now. Take that, pay those a couple extra dollars in taxes, and then go forward with Roth IRAs. Okay, who should not convert? Seniors who need the money to live on. If you're going to need these funds, within a few months or years, you certainly don't want to convert. you don't want to impose upon yourself a tax liability like that, because you need the funds. Those who believe they'll be in a much lower tax bracket. I don't see that scenario very often, but I mean, it could play out. Those who just can't bring themselves to pay the taxes. Now, this one I see, especially in large IRAs, those who don't trust the government to keep the tax-free deal. So here's the thing about the tax-free deal. The federal government actually loves Roth IRAs, but they get the taxes now. You know, that's what we forget. I mean, we don't forget. We realize it when we pay the taxes, but it's a win for the government because they get the taxes now. They love Roth conversions. They love it when you do that. Otherwise, I got to wait till you're 72, and then they only get 3.65%. You know, starting at age 72. So I don't think they'll ever go away. I think they've fallen in love with them. They're willing to trade future tax free for current taxes now. So I don't think that'll happen, but that's my opinion. So just again, keep in mind, I said this before, but the Roth conversion will increase your income taxes, okay? And they may impact credits or other deductions that are on your plate that you were using. So just be mindful of that. It could increase your taxes on Social Security. Social Security is taxed at two brackets, 0, 50%, and 80% of your Social Security. So maybe it pushes you from the 50 to 85%, excuse me. Maybe your premiums in Medicare could go up, you know, so just want to be mindful of that. And we can help you with all of these, you know, thoughts. And once you're over 72, it's no bother converting. No reason to do that because your RMDs are going to force the money out. Okay, some more folks don't want to convert. You don't have the funds available. You don't have non-retirement assets to pay the conversions. The conversions cannot be undone. There was one time when you could recharacterize a conversion if you didn't like the way the market was turning out, or you just had second thoughts. That can't be done anymore. So once you got to be ready to do this, ready to pay the piper, pay the IRS, pay Uncle Sam when you do this. Anyone's going to need the money immediately. It only really is advantageous if you're going to be able to wait, take advantage of tax-free growth. Those who want to name a charity as a beneficiary, spoke about that. Certainly you want to leave those in an IRA. There's no reason to convert those funds to a Roth IRA and pay those taxes. Leave them in IRA, charity won't get taxed, you won't get taxed, and it's a great way to use those funds. Anyone receiving financial aid, again, that might spike your income. So again, just be mindful of that. We've kind of mentioned that a couple of different ways. All right. Many times individuals don't want to pay the tax on the conversion if they're forced into a higher bracket. The solution is to execute smaller runs. So I've talked a little bit about this, and hopefully you can see that the value in doing it that way. Simply stated, you fill up the lower tax bracket with the amount converted to a Roth IRA. So let's look at that. So let's just say, let's pick a number. It's not unusual for a married couple in this area to be in the 24% tax bracket. So they're making over $178,151 in this area. Or it could be the other, the 22% tax bracket as well. But those are the current tax rates right now. Okay. So this is what we do. In 2022, a single taxpayer could have a taxable income of $89,075 and still remain in the 22% tax bracket. So this is the filling the gap tax bracket strategy. So if Mrs. Jones has $70,000 of taxable income, she can convert another $19,075 into a Roth IRA and still stay in the same tax bracket. So that's the strategy simplified, right? Just fill up the bracket. Now, keep in mind, even if she goes over 22% bracket into the 2024, it's a graduated tax rate. So only the amount that bridged into the 24% tax bracket would be taxed at the higher rate. The rest of it would be still in the 22% bracket. Another example, let's say a married couple filing jointly can have a taxable income of up to $178,150 and still remain in the 22% tax bracket. If Mr. and Mrs. Smith have a combined income of $150,000, then they have room for $28,150 of conversion to still stay in the tax bracket. So hopefully that gives you some real examples of how that works and what the tax bracket strategy would look like. And again, even if you went over a little bit, not a big deal. It's only that little bit that spills over would hit the higher rate. But certainly this is a strategy that I think is very practical. Okay, so your head's probably swimming. You're probably wondering how do I do this? What's my plan? So hopefully this action plan will help you, think through. And we are recording this, and as soon as we get, reapproved by compliance, we'll be sending it out too. So no fear if you miss some stuff, and certainly you can call us too. So first thing is, if you're able to, that is, you're under the limits that we talked about in one of the early slides, you can open a Roth IRA. Okay. If you're over the income limits, you convert to an old 401k to a Roth would be another way to do that. You can also contribute to the 401k side of a Roth. Okay. I'm sorry, the Roth side of the 401k, TSB, 403b, whatever your plan is at work. Okay. So open a Roth. If you're not able to do that, use your work retirement plan Roth. If you're not able to do that, consider converting. Remember, all Roth conversions are final. Make sure you can pay the taxes with other money. Consider Roth conversions later in the year when your tax situation is more clear, your income is more clear as well, so that you kind of better know, what that would that tax bill would be like. And again, finally, or not finally, but one more, consider a series of smaller Roth conversions over the years to lessen the tax back. Basically, you're just going to manage the taxable consequences for yourself. $50,000, $25,000, $100,000 a year, pay the taxes and get those funds into Roth IRAs. So if you're within a few years of age 70, and you haven't begun Social Security payments, you may be a good candidate for doing a series of Roth conversions over several years with the goal of reducing or eliminating RMDs, required minimum distributions. They start at 72. So if you can reduce or eliminate those, that would be wonderful. If you are near 65, again, the Medicare IRMA charges, which is your premiums for Part B and D, have a 2-year look back. For doing conversions at 63 or older can increase your Medicare premiums. And unlike tax brackets, once you go $1 over the Medicare premium rate or bracket, you're paying that for the whole year. So it's not like the tax brackets where it's graduated. So you go $1 over the next bracket, you and your spouse are paying the higher rate for that year. So consider conversions at age 62 or earlier if possible to avoid the higher bracket. Okay, that was a lot of information. I hope you guys got a lot of good takeaways and ideas, and we'd love to chat with you further about your personal situation or anything that anything specific that you want to talk about. This information and connecting with everyone. So email me, call me with anything specific. Other than that, hopefully we'll see you soon. Have a great day.